Hello, 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 everybody. Welcome to episode 20 of Mortgage Matters. And today is a major milestone because it is episode 20. So I am joined today by my co-host, Christian Babcock, who I will bring on in just a moment. But I want to stress the importance of whether you're a listing agent, a first-time home buyer, a seasoned investor, this podcast and this stream is specifically made for you guys. This is here to give you some insider tips from myself, a 20-year veteran of real estate as a associate broker, and Christian Babcock, who's been in the business just as long as me, probably a little bit longer. So buckle up and we're going to get started right away. Let me get Christian in here. Hello there.
Hello, how's it going?
What's up, man? How are you?
I'm good. It's like half my head gets cut off with this blurred background. I gotta work on my background skills. What's going on?
You got to get you a nice wall behind you.
I gotta get a nice wall behind me. That's right. It was one step at a time. We got the bed down, the thumbnails. I get the thumbnails now. We're getting there.
Yes, we are. Hopefully before 2025.
That's it. Next year we'll be working on green screens and special effects and everything else.
Well, that's when we actually bring in like a producer who's going to be in the background producing these things.
Okay.
I got this cool thing. It's called a stream deck. And what it does is like you could set up settings. So like with the push of a button, I could put Mortgage Matters and all of this stuff appears with specific language and all this, jazz. I just haven't set it up. It's literally been sitting in my desk drawer.
Well, I gotta get it out of there. Well, yes, that's our goal.
So how did you, so when I was doing the intro, I was saying that I had 20 years experience. I know that you're in the business for 20 years. How many years are you actually in the business, licensed?
22. 22. May of 2002 is when I started. So I just had my 22nd year in May.
All right, cool. Listen, so between the two of us, we're at 40, almost 45 years of experience.
A lot of experience. I'm just starting to figure out, this business. just catching my groove.
Oh my God. When I first started in this business, like, my dad was like, get a license, right? Because there's three of us, me, Michael, and Daniel, right? So Michael at that time, and he was doing a lot of property management, and he has continued to grow that business. Daniel was going to law school, and then I was the broker. So he was like, get your broker's license, so that way we have all three areas of the business covered.
Nice.
And, I never thought, honestly, like, I was like, all right, I'll get my license, but I didn't really think it was going to, I didn't think of it like this is going to be my career.
Right, yeah.
And then look, here we are now, 20 something years later.
Right. Yeah. Well, when I started doing mortgages, you didn't need a license. You basically, I got hired at Bank of New York through a network of friends that, they were in there. Then they got kind of me in there. I was trying it out. Wasn't sure if I'd like it. I had a sales background, which helped. So I was good at, like closing, handling objections, stuff like that. So I had a really good sales background, but I didn't know anything about doing mortgages at that time.
Mm-hmm.
And then it just really, after Dodd-Frank and all the licensing and everything else, it's definitely weeded out a lot of people, that may not be able to get licensed, which is good. Now I feel like it's become much more of a profession now than a job. And that's how I always treated it, is like as a professional, as opposed to like a 9 to 5. So
when you first started, you said you didn't need a license, and then so what happened? You had to then, once they passed a law, and then you had to go and get licensed to continue, or were you like grandfathered in or something?
So after the recession, so 2010 they passed Dodd-Frank, which changed a lot of the laws. But even then, if you worked for a federally chartered bank, you still didn't need a license. So if you got hired at a Chase or Wells Fargo or like some of the federally chartered larger banks, they still didn't need licenses. Now that it's kind of a hybrid. Now I see the bankers that work for those banks are getting licensed. They have NMLS numbers.
Mm-hmm.
I'm not sure if they have to go through the same licensing requirements as we do, working at a federally chartered bank, but that I don't know. But when it first started out, they still didn't need to be licensed. But outside mortgage brokers, independent lenders like us, once that all changed, we had to take the federal exams. There's continuing ed we have to do every year. We got to get refingerprinted every couple of years.
Refingerprinted, really?
Oh yeah.
Interesting. I wonder, like, once your fingerprints are in the system, what's the? I'm just trying to figure out the reasoning. Like, it's not like your fingerprints are going to change. They have it in the system.
I mean, they got to update the fingerprints. I don't know. So every couple of years, they got to update your fingerprints. I'm going to tell you. I didn't make the law.
Just follow them, right?
I guess it's it's updating the search, seeing if you've been arrested in the last 2 years or committed any crimes or felonies. They got to run it through. They just run it through the system. But yeah, I mean, if they have them on file, they could probably just rerun them. But.
Yeah. Well, I guess that's kind of like their way of. Well, I'm sure you get charged every time you do it, right?
Yes.
There it is.
Yeah.
There it is.
Mm-hmm.
Every couple of years, we'll just hit them for $30-$40. We got a couple of 100,000 people in there, just
right. Exactly. Make me drive to some location, get fingerprinted in and out in 30 seconds, pay my fee and move on.
Yep. I had to get fingerprinted when I got my New Jersey license. Here in New York, I didn't have to do that, but when I got my Jersey license, they had us. They fingerprinted us, and quick inside, boom, 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 fingerprints.
That's it. I'm clean.
Yeah, exactly. Thank God. All right, so lots to discuss, my friend. Well, first of all, 20 episodes, bro. 20 episodes. I'm very proud of us.
Yes, feels like yesterday when we just started. So yeah, we're doing good. We're doing good. We're getting there.
Yeah, man. All right, so talk to me, man. I mean, this week a lot of action. I'm gonna do your shtick for a little bit here and state that the jobs report came out a bit higher than expected. I think unemployment is now at around 4.3%. And that is what caused these rates to come down. Am I accurate? That's what I'm kind of reading online.
Yeah, we'll run with that. I mean, and it was basically right. It was a bad inflation, not bad inflation, bad jobs reports that came out last Friday that really caused a lot of recession fears. To getting hit in headlines like, oh, or does this mean we're going to be heading into a recession? Which has always been the Federal Reserve's goal is to not push us into a recession, but by raising rates, they definitely want to be slowing down the economy to get inflation under control. So the talk of the soft landing, which is what their goal has been, like, all right, how do we slow things down without pushing the country into a recession? So people are skeptical on whether that's possible or not. So once that report came out, it was like, are we really going into a recession here? Are we not? Are we seeing a soft landing? Are we seeing a hard landing? So there's a major sell-off on the stock market on Friday, a rally in the bond market. The rally in bonds caused Treasury yields to come down. The 10-year came under 4% for the first time in quite a while.
Yeah.
Mortgage backs did the same, which is what mortgage rates follow. So we saw as much as 0.5%, a little more than even 0.5% dip in rates within just a few days. So now we did lose some of that this week because then some positive news came out this week. But we still are in a better place than we were a week and a half ago. We're riding in the low to mid sixes. I was able to lock a few people in, caught that dip, that are closing in the next couple of weeks. They're very happy campers because they were.
Good. That's wonderful.
I started their applications. Some of them were as high as 6.875. I locked a couple at 6.125 without points.
Nice.
So yeah, that's always a good day when you're making that call.
Nice. So, did you have your cape on that day as saving everybody?
That's right. I came out from under my desk and like I did it.
I can picture the purple cape with the LD in the back.
Yeah. But because of that, we were also starting to see some refinance activity, which is, what I was talking about, one of the things that we wanted to talk about today. I mean, a lot of people, I have some people that bought in the last couple of years, some of the rates were in the mid to high sevens. Some even caught almost 8% at one point, so once, I've had, when I was locking those people in, when they were closing, the conversation was always, look, if you start to see things come about 1% or lower than what you had, we should talk about a refinance.
Yeah.
Refinance, for those that don't know, not everybody, believe it or not, well, number one, a lot of people don't even know that I do refinances, believe it or not. I've had a lot of realtors ask me, do you also do refinances? It's not a stupid question because I do so much purchase work and I deal with, mostly agents and stuff. And I do most of my business has always been purchase. it's just that it's not an unusual question. So the answer to that is absolutely yes. We do refinances.
Yep, yep, yep,
Um,
yep.
because what a refinance is a brand new application, a brand new mortgage application that's going to pay off your existing loan.
Yep.
You know,
And
so
basically reset the rate, right?
right,
So if
right.
I bought a house last year and bought a house for 700,000 and I had a, let's say, a $600,000 mortgage at
Mhm.
7 whatever percent, now
Right.
I can go back, and if I still have that high balance, whatever, it's probably not moved much in a year, but I can now
Right.
go back and lower that rate to get the
Right.
payments down, right? That's
Right. You
essentially,
lower exactly. So you're starting the clock over with a new rate, new terms with a lower payment. The cool thing is in this cycle is that the people have gained so much equity just in the last 2 years
yeah.
that some people that put down low down payments, let's say 3.5, 5% when they bought,
Uh-huh.
might have as much as 20% equity. So not only are they refinancing, getting a lower rate, but they're dropping the PMI.
Check. Get rid of that 200 and something dollars a month, right?
Right. So that could be anywhere from $200 to $500 a month that you're dropping just on the PMI cost, plus maybe another $300 on a larger loan savings. So I mean, you could see a major savings if you did an FHA or even a conventional loan with a low down payment. But also if you let's say for example you're not in that position, you don't have 20% equity, but you have more equity with private mortgage insurance, it might not come off entirely, but the new terms of the new insurance could be significantly lower. That could be cut in half or even less on top of the lower rate. So,
Yeah. Yeah.
I'm talking to a lot of people and we're saving them a lot of money already with just a 1% dropper. Some people have 1.5% drops right now from where they started. Another customer that I have right now, which is an interesting thing. She owns a co-op and she owns it free and clear.
Yeah.
So I don't know if she bought it all cash or if she just had a small mortgage when she bought it or what her situation was, but she's owned the co-op, which is worth over $300,000, and didn't realize that she can take a mortgage on a property that is owned free and clear. So,
Of
so
course.
she's got this, so she's got 100% equity. When I was going over the numbers with her, between her car note, her credit card, she had some installment loans, like all this other stuff. She's got good income and she's been paying these bills, but her minimum bills on this stuff was almost $3,000 a month. We're consolidating everything into a 30-year mortgage, is going to $1,200 a month.
Yeah.
And
Look
she was like, I can't even believe. She's like she didn't even know she could do it.
at
So, so stuff like that. It's it's a win. I have other people that I've helped that are really struggling, and that's the big thing now with credit card rates being in the 20s in some cases. People are looking to try to consolidate that debt, and in a lot of cases, they may have refinanced their mortgage back when they were super low, or they bought when they were super low, so they don't want to disturb their 2.5, 3%, 30-year fixed mortgage. So that's where second mortgages come in.
Yeah.
We talked about it slightly a little bit on the last call where, we have, closed end second mortgages where we can give you a 20-year fixed loan just to consolidate the debt and put it behind your first loan. So you can have a fixed
As long as that equity's there.
as long as the equity is there. So and those again, major, major savings when you're consolidating credit card debt that's in the 20s, and on the closed end seconds, those rates are still tied closer to prime, so they could be in the 8s. That's still a huge savings when you're spreading it out, and it's principal and interest. So now you actually are whacking away at the principal also
Yep.
instead of just making interest only payments.
Yep. That principal and interest factor, like the fact that you're able to pay down part of the
Mhm.
principal with each payment is huge,
Right.
because I see a lot of these interest only sort of situations, especially like specifically on the investor side, and they're
Mhm.
like interest only for 12 months, interest only for 24 months, and then they end up extending it, and now
Right.
all of a sudden you're into it for 3 years, 4 years, and you haven't paid down a penny, but you've paid so much money in interest.
Yeah. Yep. Well, on the commercial side and the investor side, you're looking for a return, on the,
Yeah.
and an income. So it's more commonly used for those types of loans for that reason. But yeah, if you're getting hit with a balloon and you're trying to get out of those loans and get into a new one, that's where, we're going to see, really already started seeing a situation in the commercial real estate world.
Mhm. Yep,
Yeah.
yep, yep.
But,
And correct me if I'm wrong. You if somebody has an existing loan with you, right?
mhm.
Don't you guys discount part or all of the closing costs, so that way it doesn't really cost the borrower that much money to do the refinance?
Right. So in New York, unfortunately, it's, even the most expensive state to do a refinance, because the New York State still expects to get their mortgage tax.
Oh,
There's still some
goodness.
title fees. There are ways, there is a loophole to avoid the mortgage tax, and it works very well with larger loans. Smaller loans, we really don't do them with, because the cost of the loophole is, it almost sometimes exceeds the mortgage tax. So it really
Yep.
depends on the situation. But there are, there are mortgage tax, title fees, things like that. What we waive, though, are all of our specific lender fees. So processing, underwriting, appraisal, all that stuff is waived. We call it our lifetime guarantee at Loan Depot. So, and then again, if we're doing the CEMA, to avoid the mortgage tax, we also, if we're servicing that loan, do free CEMAs as well. If we're not still servicing the loan, we could still do a CEMA with whatever servicer is handling that loan. So
Yeah,
that is,
because you guys don't you guys sell a lot of, well, not you guys, but the industry as a whole.
yeah,
If
the
somebody
industry.
does a loan, if somebody does a loan with Chase or with Wells Fargo or your average lender,
Mhm.
Chase doesn't, you could 4 years later that loan could be now sold to somebody else, right?
Oh yeah, when I worked for Chase, I had my loans sold to other banks. They would sell them in the city, or they would sell them to other sub-servicers. Bank of America sells to a lot of sub-servicers, stuff like that also. Servicing is just a whole other part of the business. So we do retain the majority of our loans, but we do sell some. But again, our lifetime guarantee still applies. So if we sold your loan to Chase and you're going to come back to us for the refi, you still have the lifetime guarantee and the waiver of the fees. It doesn't have to only be serviced by us.
Lender for life.
That's it. That's it. That's it.
Just kind of going back to the jobs report, and like now that, like, since we've been doing these episodes, and every single week now I'm getting more and more well versed on the market, and specifically these reports and how they affect it.
Mhm.
Originally you're just like, people, and me included, like, just looks, oh, but they need to cut rates, they need to do this, they need to do that. But now, speaking to you every week and understanding how everything impacts the other, like, it's not easy to be the Fed. Like, they have to really try to balance the interest of the country as a whole,
Right.
instead of just looking out for one subsector. You
Right.
know what I mean? So, like,
Right.
they're lowering rates, raising rates. It's really just a balancing act.
Yeah, I mean, it's, way above my pay grade and yours, but I gotta, I have a hard time sleeping at night just knowing, rates are going up or down. I don't know how those guys sleep at night if they do it all, you know. But yeah, it's a big responsibility, and if they push the country into a recession, that affects the global economy, and we're not just talking about locally or nationally. I mean, it's, we have a global economy.
Yeah.
So it's a very, it's a really amazing to kind of watch and listen to the press conferences and see what goes into this stuff, and how it affects your day-to-day life. I mean, inflation, people don't really start paying attention until they start seeing it impact their wallet. And that's what
So
you're seeing
they go grocery shopping.
right, until all of a sudden you say, like, oh wait, last year I bought the same stuff and it's twice as much right now. So, and their incomes haven't changed. I mean, there are indicators though showing that wages have come up a little bit also. So people's wages are increasing somewhat. But, an average person making a salary, even with a 3%, increase in salary year over year, when inflation is up 20%, your salary is not keeping pace.
Yeah.
So, when we're up 20% from 2022 or 2021, when inflation really started going out of control, actually 2022. So, I mean, 20% over, in 2 years, and maybe you got a 6% raise in that amount of time.
Yeah.
No.
Yeah. Maybe,
So,
maybe you got
right. Maybe that's if you get 3% per year, which not everybody gets.
no,
So,
not everybody gets that at all. So think about that, right? Like, it's just kind of like, if a gallon of milk was $4, now it's 4.80.
right.
Right.
It's and some things are more, inflated than others, so depending on supply chains and all that stuff we went through with COVID. But, as now they're talking about supply chains are back intact. It's a matter of, and with high interest rates, people spending less money, we'll start to see inflation, and it has been working. It's been slowly cooling, probably not as fast as people would like to see, but it definitely has, it seems to be working. So.
Yeah, so just kind of, for the first time listeners, and just to kind of reiterate, right? So unemployment has gone up, which means that there's more people that are not working. 4.3% of the population, essentially, they're saying is unemployed at this point. So because of that, they would then reduce the rates because they want to make it more affordable to buy or own a house because less people are working, right? That's essentially the thought process there.
Not really. I mean, it's not really driven to just home ownership. I mean, jobs are, really lowering rates makes it more affordable for like a business owner to hire.
Okay.
So
Right.
if it's unaffordable for somebody to hire people, because they're paying more for whatever labor, supplies and everything else that, contractor, for example, if they have to spend more money on supplies and they're not getting the profit back, they have to lay people off. And they just don't have the work, and when we start seeing a downturn, people are spending less money on things like home improvement and, so now you got people that more laborers or stuff that are out of work because there's just not enough work to be done. So, and that's just one segment of employment that gets affected by, I mean, every when you have a downturn or a recession, it pretty much trickles into every industry. When there's less money being spent, there's less money to be going around, and that causes unemployment.
Man, it's just to like owning the asset, right? Like figuring out a way, like you and I, we beat it every single week. We're beating into people's heads. Like if you can afford to buy, there's no time better than now, right?
Right, I was just thinking about that. Like I've been saying for 22 years, there's never a bad time to buy real estate, and for 22 years, I've been right.
Yeah.
Yeah. Really, when you think about it, I mean, again, minus the major recession where people did lose money in their equity, their homes, and obviously there was a foreclosure crisis and everything else. But again, that was an anomalous situation because the entire the economy is being propped up by bad mortgages in an unregulated market.
Yeah, I was just about to say most of the people shouldn't have been able to buy those houses to begin with.
Right. So we saw a major correction after the sins of those of the people involved in that situation. So but again, in a normal world, in the world we've been living in for quite a while now, it's never a bad time to buy real estate.
Yeah, and having that asset, having that fixed expense every single month allows you to open up all these doors, the second mortgages, the consolidating debts, all of these different things. And it just shocks me sometimes that people are not working towards this. Like when I say people are not working towards it, I'm talking about the average person that just not necessarily so well versed, right? And that's who we're primarily talking to, right? Like if you're sitting on the sidelines and you're like, all right, you know what? I want to buy a home. I want to take advantage of this. And then, talk to me. We go through the process and you're like, all right, well, right now, unfortunately, I can't approve you because of X, Y, and Z, whether it's credit, whether it's down payment. Those are obviously the two big ones, right? And then you're like, all right, let's set a plan for the next 12 to 24 months. And most people think of that as too far away to do the little tiny steps every single day to figure out a way to get there. And it's really just about mental toughness, really, and really just the ability to stay time on task. Right? Like every single month. All right, cool. Groceries. We're going to keep the grocery bill down to $100. Obviously, inflation and whatever, but we're not going to go out to eat as much as we used to. Like doing these small little things will allow you to pay off the debt, which will then snowball into you cleaning things up over the course of, whatever, 12 to 24 months, even if it's 3 years, whatever it is.
Right. No, I mean, that's why there's a big push, and start seeing people talking about teaching financial literacy in schools.
Yes. Oh my God. How to balance a checkbook. Like I didn't learn how to
balance basic financial literacy. And where we are, in and around New York City, you have generations of people, like multiple generations that have always rented.
Yeah.
So if you're not taught it in school, and if you're not, you're not taught by your parents because their parents rented and they rent, and now you're, who's thinking about buying? I mean, when my parents owned a home, and even when I moved out in my early 20s, my first thing was I'm going to go rent. That's what you just did. Like I'm moving out of my parents' house. What am I going to do? I'm going to go rent. So I rented, and I only bought my first place because a guy that I was working with was in the middle of buying it, and he got fired from his job and couldn't get the mortgage. And he was like, "Oh, I was in the middle of buying this co-op. You want to buy it?"
Oh, okay.
And I looked at the numbers. I was looking at the numbers. It was this is going back to 2000. I think exactly the year 2000 or 2001. I can't remember exactly when, but it was a 1-bedroom co-op I bought for $45,000 in Yonkers. I put 5% down, right? And between that and my closing costs, I think I spent a total of $5,000 to buy it. My mortgage payment was $280.
Oh my God.
And the maintenance was $350. And I was in a 1-bedroom with a pool, security,
Yeah, I know the building. I know the building.
Right? And my rent before that was $850. And so it was a no brainer. And then I sold it after maybe 5-6 years for $125. I mean, it depreciated that much in such a short period. And again, that was just dumb luck. It was not planned. It was just, I know a lot of people that make money by accident. And I was one of them. Like that was just really just luck. That I just felt that opportunity just fell on me. And then I would never turn back to renting again after that.
Of course not. I mean, you had such a positive experience.
Right. So, and again, and even in that co-op, I actually had consolidated debt. When I was there, I had a car payment. I had some credit card bills because I bought furniture and stuff like that. And I was doing that. I was just paying the minimums. Mm-hmm. And then when it appreciated, before I sold it, I actually did do debt consolidation. I paid off the car. I paid off my credit cards, reset it. The mortgage payment went up like $100. Mm-hmm. And now I was debt free. And then it still appreciated. I still made money when I sold it.
Yep. Never a bad time to buy. Jen's kids, I harp on it because they're still living at home. I'm like, listen, when you guys are ready to move out, like, just make sure that you're not going out and you're becoming renters. Like, you don't want to, like, you want to make sure that you're setting yourself up. Because if you buy something at a young age in your 20s, it's just like, the statistics don't lie. Like, there's stats out there, and I can't really roll them off the top of my head, but basically saying that if you own your home, obviously, number one, your net worth increases tremendously, probably 100%. Number one. Number two, if and when you have children, they're going to be better off. Yep. And you're just setting up that generational wealth, even by owning a co-op, like the smallest sort of transaction that you could probably do here in New York City. Just owning that co-op, and your average co-op, 125, the cheapest. If you put a studio, whatever it may be, that $125,000 worth of equity just helps you in every single aspect of your life.
Yeah, no, absolutely. And I am seeing a lot more of that. I'm seeing single women, single guys going right from their parents' house to buying.
Yep.
And they might be staying in the house a little longer than the parents want, but the parents are helping them, understand to save some more money for a down payment and go in to buy something instead of going out and renting.
Yep.
So, but it's, look, everybody's situation is different, and but I definitely think financial literacy really needs to be taught at a high school level, or even like early college level for sure.
Yeah, I mean, listen, those economics classes that I took in the prep didn't really set me up.
They call it sleeping on
it. Basic stuff, right? Like, I remember supply and demand, but like, really, like, how to understand money, like just the simplest stuff, like we said, balancing a checkbook, like understanding the power of compound interest, both in a negative and positive way, right? Like those credit card debts, that compound interest that just continues building up, and over the course of a year, like, you know how many people I speak to that when I ask them, like, oh, whatever, I'm like, how much you have in credit card debt? They're like, oh, maybe like 10,000. All right, cool. So what are your interest rates on those cards? And they can't even tell me.
Right.
I'm like, I guarantee you they're probably anywhere from 18 to 27%, which means that if you have a $10,000 debt, you're paying almost $3,000 a year just in interest. And if you're only making those minimum payments, you're literally just paying the interest.
Or, that's the slippery slope. It could also be killing your. I just spoke with a woman that has 10,000 in credit card debt, spread out over 8 cards. Every one of them was maxed out.
Yeah.
And they weren't big dollar amounts. They were $250, $300, like little cards, all spread out, but all maxed out. And their credit scores in the 500s.
Yeah.
Because with the algorithms, once they pick up a maxed out credit card, they start dropping your credit. So now you're in a situation where I got a score in the 500s. Anything else I try to borrow, car payment, car lease, another credit card, you're getting the highest interest rates on all of that stuff.
Yep.
So not only impacts by putting in debt, it actually gets you into a pattern of now everything else is going to be more expensive because you have a low credit score.
Yep. That utilization, right? Like staying under that, 33%, right? That's what Micah had said to us. 33% is where you want to stay under?
Under 10% if you can, but 30% ideally. But even if you can keep it under 10% of a credit limit, that's where you want to be. You know.
Yep. Moral of the story, boys and girls: buy dirt, buy land, buy property, right? Like, just figure out a way to make it happen. And if you need some help figuring that out, that's what we're here for.
That's right.
All right, Christian, thank you very much. I'm going to wrap this up right now. I appreciate your time, and I'll see you next week.
All right, bud. Thank you.
All right, take care.